To a lot of people, this doesn't make sense at all. As soon as you start mentioning things going back over 100 years ago, they think we've lost the plot. And I remember reading some comments from people saying, what are you talking about?
The slightest pullback, I think, over the whole system is going to lead to a cascade of people trying to get out of their IOUs. And the stock market says, we don't see anything to worry about. Well, that's exactly the position we were in 2007. So I think we could be very, very close. 1929 is nothing. 2007 is nothing. People are bullish relative to all other previous times that we've measured.
What do you think about this? How much further higher could this wave 5 go?
My view is it's topping right now. I think the market is so crazy.
All right, guys, hello and welcome. We're very honored today to have special guest Bob Prechter of the Elliott Wave International Financial Forecast Service with us. This should be a really fascinating interview and video because I'm going to ask Bob what his views are about the stock markets. What is the thing about the long-term potential for the stock market, the Dow, the S&P? And what about these charts I want to talk about here? For example, this chart of the markets going back all the way to the 19th century, to the 1800s. Could this have a bearing at all on the major markets? And where does Bob think we are potentially in the overall big picture? How much further higher could the stock market go? In fact, what is Bob Prechter's timeline for where the potential top could be for the stock market? Is it going to be much higher, above 6,000 on the S&P? Is it going to be sooner or is it going to be later? Should be quite interesting, guys. Join us. Okay, guys, welcome back. Bob, thank you very much indeed for agreeing to be with us in this particular video. I've been really counting days and weeks to speak with you. And you're one of the most fascinating people. The number one reason why I use Elliott Waves is because of yourself. One of the things people always ask me is, which books do I recommend when it comes to Elliott Waves? And I always say, get the Elliott Wave Principle by Frost and Prechter. And the second book, guys, you should definitely get is Conquering the Crash. All right, guys, lots of great information there. By the way, guys, before we start, make sure you go ahead and check out the special offer from Bob Prechter, which is for only $7, you get 1 month's access to everything that Bob offers in the Elliott Wave Theorist, the special newsletter that Bob edits, and also the Financial Forecast Service and the short-term update. By the way, I also am a subscriber to Bob Prechter's service. I read his newsletter regularly and religiously every month. I think you get a lot of benefits by reading his newsletter. It's fascinating, very interesting and informative, and also educational. So definitely, guys, go ahead and check out the special offer. Again, the link is right there, elliottwave.com/Alessio. And for only $7, you get access to everything that Bob offers, including the October and November newsletters. Bob, thank you very much indeed. And my apologies to everyone for that preamble first. How are you? I know you're in the state of Georgia. I'll be coming very close to you in Christmas time, Florida.
It's beautiful out here. It's going to start getting a little chillier on Monday, but I think it's going to be almost 80 degrees today. So it's awesome. As soon as we're done, I'm going to be outside.
That's fantastic. I'm bringing my mom, by the way, just let you know, Bob. So for the first time, my mom is going to see Florida.
Is your mom a chartist?
Hopefully I'll make her one. Bob, listen, before we start, if you don't mind, because often when I mention your name in my videos, there's always going to be the odd few people. And the majority of our viewers are intelligent people, intelligent, sophisticated people. But there's always going to be the odd few people who are going to say, well, Bob is too bearish, or Bob is always bearish. He's a perma bear. Let me just say, first of all, as I mentioned last year, that is completely untrue and unfair. I've read your work. I've read your newsletter. That is simply not true that you're a perma bear or any of that stuff. You've held bearish positions in on the markets. You've also held bullish positions in the market. So I really respect your work. Let me just say that I really respect your work, Bob, which is why I read your books and why I read your newsletter. Now, there are occasions when I may disagree with you about certain things, but that's okay. But on the majority of things, I actually agree with you when it comes to analysis and indeed when it comes to the markets. Bob, if you don't mind, I want to essentially state to everyone, what is your key claim when it comes to the markets right now as we speak?
Yeah, sure.
And you can tell me if I'm wrong. Bob, essentially, I think your main claim, in other words, what the base case or your overall expectation in regards to the markets is, as far as I think. So we've been in a bull market. I think that's without doubt. We've been in a bull market since 2009, the overall 15-year-long bull market. The second major point is that we've been in a much bigger, longer-term bull market from the 1800s, going back all the way over 100 years ago before the Great Depression, so a much bigger, longer-term bull market. Now, I think your base case, your main claim is this about the markets, that we're in the final wave 5 of both bull markets, not just the 15-year-long bull market from 2009, but also the wave 5 of the longer-term bull market from the 1800s, from the 19th century. That's a pretty major claim, but I think that's correct. And the second point, I think, in your base case, your main claim is this, that we're in the final stages of this wave 5. We're in the last gasp or last climax stage of this wave 5, which means we're approaching a potential top in the market. And I will ask you in this video when you think or what key levels we could reach this wave 5 top. And I think the third point of your main claim, your base case, is this: that when the markets eventually top, maybe in the next couple of years, or again, you'll explain this in this video, when the markets eventually top into wave 5, you're expecting a big, major crash type downtrend, or indeed reversal in the markets, similar, if not worse, to the Great Depression crash of the 30s, of the early 1930s. In other words, this next major crash, which might occur sometime in the next several years, will eventually retrace this entire bull market. It will be a correction to this entire 100-year-long bull market. Bob, am I being fair to you in stating these 3 key points about what you expect in the markets?
Yeah, for the most part.
Thanks. Okay.
Well, it's important to realize, though, that in a world of fiat money, we are forced to look at different ways of valuing the stock market.
Sure.
If you value the stock market during the Zimbabwe hyperinflation, for example, you say, oh, it's a bull market. Well, of course it is, because your measuring unit is crashing. However, in real terms, it might not have been a bull market at all. We follow several different ways of measuring what the Dow is doing. One is the one everybody else is watching, which is the nominal Dow, the Dow in dollar terms. And there's no question, yeah, of course, it's been going up for the most part. The one I prefer, the one I think is the cleanest, is the Dow/PPI. Now, what's interesting about that, I've had a very clear 5 waves up in the Dow PPI. So you had the first wave up to 1966, then a correction to 82. It was a 60% decline. Then you had a run up to 1999, and then another 60% decline, which ended in 2009. So we're absolutely in the 5th wave up. But there are other ways to measure it. And that one way I like a lot is measuring the Dow in real money, which is to say gold. If we were still on a gold standard, people would know that the Dow is actually lower now than it was in 1929. We've had no bull market at all. It's cheaper than it was in 1929 by a substantial amount. So all that's happened is that the measuring unit has collapsed in value. Now, the Dow gold ratio, which is to say the Dow priced in real money, topped in July of 1999 at 41 ounces of gold. That's what it was worth. It collapsed down into 2012. And of course, we had a bear market in nominal terms in some ways into that time as well. We had the bear market in stocks into 2009. We had real estate bottoming in 2011. And so that whole period was a difficult time, and it shows up in the Dow gold ratio. And during that time, the Dow collapsed in value from 41 ounces of gold all the way down to less than 8. Well, it rallied into 2018 and has been grinding lower ever since. It's currently worth 15 ounces of gold. So people think, oh, we're getting rich, the stock market's doing wonderfully well. Well, if you had bought gold in 1999, you'd have done better than being in the stock market. If you'd bought gold at the end of 2021, which is when I got super bearish, you'd have done better than any of the stock indexes, including even the NASDAQ indexes. Yeah, it's a bull market, but it has a lot of interesting nuances that history is going to have to unravel one of these days. What's propping it up, as I said earlier, is debt, massive amounts of debt. And that is one reason why the measuring unit has fallen, is because so much debt's been created. My book, Conquer the Crash, or the latest version, Last Chance to Conquer the Crash, is based on the idea that this debt pyramid is going to unravel. And you can start to see the things happening recently. I'm sure you've seen it as well. Junk bonds have just started to weaken a bit. Those are like a barometer where stock markets go. They tend to turn a bit early. The slightest pullback, I think, over the whole system is going to lead to a cascade of people trying to get out of their IOUs. In 2005 to 2007, while stocks and real estate were still, up and holding up, those people got more and more negative. That's been happening for the past 2 years as well. The small business owners say, no, it's tough. It's really bad out there. I'm telling you, it's really rough. And the stock market says, we don't see anything to worry about. Well, that's exactly the position we were in 2007. So I think we could be very, very close.
Thanks, Bob. By the way, guys, in just a few minutes, I want to ask Bob about his long-term projections for when and at what price level approximately the markets could top. Bob, one major objection people have, what happens is a lot of people will say, okay, listen, Alessio, Bob, I can come with you. I can come along with you on this journey that say, okay, we're coming to the end of the bull market that started from 2009, 15 years ago. Fine. I can agree with you up to that point. But you're talking about a bull market that started over 100 years ago from the 1800s, late 19th century. To a lot of people, this doesn't make sense at all. I mean, as soon as you start mentioning things going back over 100 years ago, they think, we've lost the plot. And I remember reading some comments from people saying, what are you talking about? What does anything over 100 years ago got to do with now? I mean, the times have changed. Everything has changed. What does that to do with now? A lot of the people who watch my videos, our audience, are intelligent and sophisticated people. And I know that you guys watching this video right now, I know you realize the answer has to do with fractals, fractal patterns. Elliott waves are fractals. And essentially, we're talking about different time scales, different time frames, the same pattern appearing on different time frames, self-similarity. But I'd rather you explain it for folks.
You used a very important word in our previous discussion, which is context.
Context, yeah.
Because the wave principle shows us that social mood, which I think is behind all these fluctuations, is a fractal. It means that it follows the same forms at all degrees of trend, and that includes the large degrees. All of history brings us to where we are today. So yeah, and I think the past is extremely important because it's set up where we are today. And if you just think, well, I need to look at Thursday's number, you have no idea, no clue where we are in the context of the larger picture. Let me just give you one example. We've probably showed dozens and dozens of sentiment indicators. This is a well-known indicator. Warren Buffett likes it.
Yeah.
This is the Wilshire 5000 we're talking about.
Sure.
Now, that's a 6 times multiple in the valuation of stocks. We're not just talking price. We're not just saying, oh, it went up and everything's great because the companies are doing well. It's a benchmark multiple relative to the output of the country. So it tells you people are 6 times more bullish as they were in 1982 in terms of simply valuing stocks above what these companies are producing. 1929 is nothing. 2007 is nothing. People are bullish relative to all other previous times that we've measured.
Let's go to this particular chart. So, Bob, this is actually from one of your newsletters, and all I've done here on the right-hand side, again, I've taken the liberty of adding my own expectation of the Elliott wave counts in blue, but I think last year when we discussed this, you did not disagree with me on this. I think you said it's a plausible wave count in blue, which I've added there. And we can see this is the long-term bull market that we talked about, going back over 100 years to the 1800s. And as we can see, that crashed there in the 1930s. That was the wave 4 correction of this bull market. And then from the 1930s, and by the way, a lot of people don't even know this. They don't realize that R.N. Elliott, again, the key founder or the key discoverer of Elliott wave theory, he was using his Elliott waves back in the early 40s to forecast a bull market that could last all the way to the 2000s. In fact, he said that the bull market could last to 2012. Now, sure enough, the market has gone beyond that in 2012. But still, for someone in the early 40s to say that we're going to go into a bull market into the 2000s, people at the time thought he was crazy. But he was right, as we can see. I mean, what do you...
said that in 1941 or 1942.
Yeah.
Look it up, but it's an unbelievable call.
It's unbelievable. Exactly. I agree. But so, Bob, what do you think about this? Let me just say that I agree with you that we are in the wave 5 of this long-term bull market. I'm 100% in agreement with you. And I think you're correct that we're in the last final stage, the last climax of this wave 5, the last stages, the last breaths or gasps, you want to call it, of this wave 5. That does not mean that either one of us think the market's going to top immediately. No. So I want to make sure this misrepresentation or this misunderstanding gets out of the way. None of us are saying the market's going to top this month or this week or this year. Okay. Bob will explain in a few minutes. But I mean, it might, sure. It might, sure. But what I'm saying is that this wave 5 could extend further higher. That's what I want to talk with you, Bob. What do you think about this? I mean, how much further higher could this wave 5 go? And I'm not gonna hold you to it. I mean, listen, but my expectation, I'll tell you right now, my expectation is that probably the S&P may go above 6,000 in 2023. 2024. 2025. 2026. 2027. 2028. 2029. 2030. 2031. 2032. 2033. 2034. 2035. 2036. 2037. 2038. 2039. 2040. 2041. 2042. 2043. 2044. 2045. 2046. 2047. 2048. 2049. 2050. 2051. 2052. 2053. 2054. 2055. 2056. 2057. 2058. 2059. 2060. 2061. 2062. 2063. 2064. 2065. 2066. 2067. 2068. 2069. 2070. 2071. 2072. 2073. 2074. 2075. 2076. 2077. 2078. 2079. 2080. 2081. 2082. 2083. 2084. 2085. 2086. 2087. 2088. 2089. 2090. 2091. 2092. 2093. 2094. 2095. 2096. 2097. 2098. 2099. 2000. 2001. 2002. 2003. 2004. 2005. 2006. 2007. 2008. 2009. 2010. 2011. probably significantly over 6,000 before we top, and maybe next year. That's my own personal belief. I could be wrong. What is your view?
My view is it's topping right now,
Okay.
but I've had that view a number of times. I've been overly anxious to recognize a top or call a top because of these insane overvaluations that
Yeah.
we.
Yeah.
I also think there are internal problems in the market in terms of some indexes having topped in 2021 and are not likely to make new highs. I can count 5 waves up in the S&P, which I did in the last letter from the 2022 low. I think if the market turns down now, it would be a beautiful ending picture that we would probably publish many times in the future. However, the market can do absolutely anything. And if the optimism gets to even greater extremes, people will figure out ways, mostly using other people's money, to push bid stock prices even higher than they are today.
Yeah.
I think it's unlikely, but I've thought that several times before, and I was very adamant in 2021 that was it. And obviously it wasn't. So we've tacked on another leg. Steve Hochberg, Pete Kendall, and I are basically calling it as done. But we, in another sense, we kind of don't care because we've said very clearly we prefer, even though, for example, we've been quote unquote too bearish during this period, we've also been bullish on things that are working better than the stock market, which is gold and silver. And I think ultimately the T-bill yields compounded are going to beat everybody starting in 2021. So, we're kind of comfortable. Even if we're wrong, we're like, okay, if these people want to continue to bid stocks higher in this crazy situation, that's fine with us. We're going to wait because we know we are the furthest from anything that you could possibly identify as a bottom here, short-term, intermediate term, or long. So we're going to wait for all the signs. Yeah, they've gone further than we thought most of the time, but we know how to recognize a bottom. We're nowhere near one, and when we see one sometime in the future, we're gonna come out and say so, and that's when people are going to be throwing things overboard, and they'll be in a panic, and they won't believe it. So anyway, that's the context that we're in, and that's when our followers are just basically they can see the charts we're showing them, and they agree with us, and they say, yeah, this is insane, and we're going to wait for you guys to call a bottom before we get in. In the meantime, we're happy with our gold and our T-bills.
Let me say again that, Bob, I do agree with overall your longer term picture. I guess the one thing I'm not clear about, and I think we're probably in agreement is this, is I guess it's very unclear as to where this wave 5 could top. On this chart, I put a hypothetical year period. My personal view is it could top, the wave 5 could top in 2025, 2026 on this Dow chart. And this is, I've just zoomed in here on that Dow chart from 2009. So I put my expectation for the wave 5 somewhere over 45K, near 50,000, I don't know, in the next couple of years. And this is the S&P chart, the last chart I want to talk about here. So my expectation personally, again, I could be wrong, is that the S&P probably will breach 6,000 sometime this year, but I think somewhere over 6,000, maybe next year, 2025 or 2026, we might see the completion of wave 5. And then, as you say, the big major reversal, the big major top, and then the reversal could occur. That's my own personal humble opinion. Let's put it this way, Bob. If the markets do exceed, if the S&P goes over 6,000 the next several weeks by the end of this year. In fact, I was bullish on the stock market just a few months ago when we had that big drop that occurred. But anyway, what's your view? 6,000 possibility or probability?
No, I'm so bearish on stocks that I would always bet against higher highs.
Okay.
As I said, we're able to count the rise from the 2022 low as having been done. The one thing I think that probably is a strength of the case that you're making and other people who are bullish using Elliott waves are making is it's not a pretty count. And very often when you get to the final high, you look back and go, okay, I see what they were doing. Yeah, now I get it. That's finally a nice clean 5 waves. And that is probably the one thing where I'd say, if you're patient and we don't have a big downdraft that wipes you out in the meantime, maybe you'll be able to call a top a year or two from now, 20% higher or something like that. I'm not going anywhere near that because I think the market is so crazy. We got a printing press. We're just going to print money.
Yeah.
I don't think that's likely, and I think the implosion of debt is going to be so swift they're not going to be able to react. That's my opinion.
Yeah, I agree with you that I think even if the Fed intervenes, it will not be able to stop the major downtrend and reversal and crash, which you expect, which I think you're going to be correct about. I think this is the big misunderstanding people have. They think that if the Fed intervenes, everything will be okay. Plunge protection team, market will go back up. Completely wrong. I think they have a completely backward view of history. The Fed intervened several times during the 2008 crash, did not help. I have to say, if the stock market, if the S&P, for example, broke below the September lows, I would change my mind. So I would definitely come to your view that we've topped, but only on the condition that the S&P, if the S&P and the Dow both broke below the September lows. If that happens, then I will certainly change my mind and become very bearish. But I'm
Well,
remaining.
it's good to have levels, but at the same time, the market may break that low, and then it
Oh,
says, well, that was 1-2, and I'm going up again.
oh yeah,
So
you mean like a false break?
I don't
Yeah.
like to use breakdowns as times that are
Mm.
bearish or breakouts as times that are bullish.
All right, guys, make sure you go ahead and join Bob's newsletter, Bob Prechter's newsletter. That's his financial forecast service, which includes his Elliott Wave Theorist and the financial forecast and the short-term update. By the way, you get access to all of this for only $7 for 1 month trial. Go ahead and check it out. I'll put the link for you guys in the description. Again, that's elliottwave.com/Alessio. I'll repeat it again, elliottwave.com/Alessio. You get access to everything, including Bob Prechter's newsletter. You get the October newsletter and the November newsletter. Check it out. It's highly worth it, guys. As I mentioned before, I'm an avid reader of Bob's newsletter and the financial forecast service. They do great work. Go ahead and check it out. You'll benefit greatly from the newsletter as well.
If you're really a Bitcoin or a cryptocurrency trader or investor, we have two guys totally dedicated to that very service. It's called Cryptocurrency Pro Service. And we watch it 24 hours a day. So if you're really interested in those things, that's what you need. Go to our website and go to the Pro Services area and you'll see it.
Bob, thank you very much indeed for once again agreeing to do this webinar. And thank you so much for being a sport and staying longer than we agreed. I really want to thank you one more time. I appreciate
My
it.
pleasure. My pleasure. Have a great rest of fall and a great winter season. And like you said, we'll get together when things are again interesting.
Yeah, absolutely. Yeah. Cheers. Thank you very much, Bob. I appreciate it.